I'm Neil McIver, founder and senior portfolio manager of McIver Capital Management. With higher interest rates available on cash for the first time in well over a decade, there's a bull market in cash these days. And as you might expect, many institutions are taking advantage of this enthusiasm by marketing various types of cash-like investments to attract your money. Some of these make sense, some of them may not. But I wish you to understand the basic topography as you consider the options being presented to you. Accordingly, I'm going to go through 3 things you need to do with your cash right now and 3 things that you should probably avoid with your cash right now. So let's jump in. The number 1 thing to do is do understand that most, if not all, types of cash investments pay you interest. And interest, unlike capital gains or dividends, is taxed at your top marginal tax rate. Accordingly, in Canada, and depending upon what province you live in, it can be as high as 54%. That means that if you're able to get a GIC or a money market instrument with a yield of 5%, the net after-tax return to you is actually just 2.5%. With inflation currently running at, well, officially just over 4%, but in actual reality, we all know it's closer to 8 to 10% if we calculate typical households. And this is not to say, by the way, getting more interest on your money is futile, but please do understand that the actual net return to you is far lower than you may have thought. The second most important thing to do is rate shop, and rate shop intelligently. There are all sorts of places that you can go to buy cash type of investments. You can get them at a bank, you can go to a credit union, an insurance company, a mutual fund company, among many others. But the vast majority of these places only sell cash investments that they themselves have created. In effect, you are lending them your money and they're trying to attract that cash and pay you as little as possible for it. You're also not getting a broad array of cash investment vehicles. Accordingly, you're far better off going to a reputable investment dealer which has access to the widest array of cash vehicles from virtually all institutions. And the investment dealer is actually on your side because they're simply trying to broker the highest rate possible for you. Importantly, there are many types of cash investment vehicles that you can safely hold your cash through an investment dealer. And I'll list them here, so go grab a pen. There are investment savings accounts, or ISAs. These are 100% daily liquidable vehicles which pay a high rate of interest. The interest rate floats directly with the Bank of Canada, well, with rates generally. These are issued by all banks as well as life insurance companies and mutual fund companies. There's no price risk. The debt is issued against the general credit of the institution, like a bank deposit, so be careful here, but the yields and the liquidity are great. Money market securities. These are bought on the market like a bond and are in effect just very short-term corporate bonds issued by companies. The maturities can be just a few days out to all the way out to about a year. They're liquidable daily and they can be subject to some price risk based upon the interest rate environment. They are guaranteed by the issuing corporation, so ensure they are single A rated or higher. Government treasury bills or T-bills. These are issued by the Government of Canada, some provinces, and are fully guaranteed to the full face value of the bond. However, much you wish to buy, it doesn't make any difference. They're all guaranteed by the government. These are usually 30, 60, or 90 days in duration and 100% liquidable on any given business day. Government T-bills, in our opinion, are the best option for those who need to hold a very large amount of money in cash. GICs and term deposits, issued by banks and credit unions and a few others. A GIC or a term deposit is essentially a contract in which the institution pays you interest for lending them the capital for a fixed period of time. These are issued from 3 months out to 5 years typically, and they typically are not liquid until there is a maturity, with some interesting variances which we like, such as 1-year GICs, which are cashable at any point after 30, 60, or 90 days at your option, which can be very advantageous. A GIC or term deposit represents the debt of a bank or of a credit union and is issued against the general credit of the institution, like a bank deposit. So do be careful here. And finally, There are mutual funds which may own cash positions like treasury bills and money market securities. So there are many options, and our suggestion is to have the broadest array of options available to you and to receive qualified advice on which option or combination of options make the most sense for you. Now, the third thing to consider with cash, it's always important to consider the term, or what we call duration, of the investment that you purchase. Firstly, you'll wish to ensure that whatever cash you invest is liquid by the day or the particular time frame that you need it, assuming the cash is earmarked for something. So pay attention to maturity dates and liquidity. Secondly, remember that many cash investments may have an attractive yield, but the rate floats with interest rates. This includes investment savings accounts or ISAs and mutual funds, etc. So if rates go up, that's good. But if rates fall, the interest rates on your cash falls immediately as well. Accordingly, you'll likely wish your cash to be a nice mix of fixed-term investments, such as treasury bills, money market positions, or GICs, which pay you an interest rate for a fixed period of time, regardless of what happens to interest rates, in combination with cash positions which float based upon the current interest rate environment, like investment savings accounts or mutual funds. Now let's move on to things you do not wish to do with cash. Please do not make the mistake of mixing up buying a cash vehicle for actual investing. It's not investing. All you're doing is just really parking cash and seeking a higher rate of return on that cash. In fact, buying a GIC or a money market investment or a treasury bill is really the opposite of investing. This is because when one invests capital, the goal is always to achieve a rate of return which is greater than inflation in order to grow your capital on a relative basis. Today, and pretty much always, cash investments on a net basis after tax deliver a rate of return lower than inflation, meaning your capital is actually shrinking in real terms, meaning that your purchasing power of your cash is decreasing, regardless of what type of a cash investment you're invested into. The second thing to avoid, and I have seen this mistake made my entire career, please do not stretch for additional yield. If it's too good to be true, it likely is. Remember, you're parking cash. You are not investing. Accordingly, what exactly is the risk that you are taking to get maybe a 6% yield versus a 4.5% guaranteed yield? We see people chasing yield all the time, and they end up complicated and often completely illiquid Frankenstein investments, often mortgage funds for various sorts. Bridging finance comes to mind. Do not do this. Stick to large, stable organizations and safe, vanilla, liquid cash investments. Lastly, the third thing you do not wish to do with your cash, and this is only if you do not wish to open an account with an investment dealer to manage your cash, and you just wish to hold it at the local bank, then don't put too much of it into one Canadian bank. Diversify and consider using a credit union. Avoid having more than $100,000 on deposit with any one bank in Canada. This is the maximum insurance each entity has for cash deposits under the CDIC, the Canadian Depository Insurance Corporation. This $100,000 of coverage includes all savings accounts, checking accounts, GICs, or investment savings accounts in aggregate. Now, this aggregate is per entity, meaning that you personally are guaranteed to $100,000, as is your RSP and TFSA, and any individual company that you control. Each is considered a separate entity, and each entity has that same $100,000 worth of insurance. Yes, it's very unlikely a Canadian bank will fail. But at the same time, it's very Canadian to be better safe than sorry. And yes, credit unions are guaranteed to the full amount of any deposit, so you may wish to consider them if your dollar amounts are somewhat larger than $100,000. I'm Neil McIver. Thank you very much for watching. Please click the link below if you have any further questions or you wish to meet with me.